So welcome back everybody. Okay, so we have with us here CMO Rohit. He is going to deal with valuation of shares and securities and the impact for the Confluence and the various legislations. So it's a very interesting topic. CMO Rohit, they will be the givers. And to give a final introduction, I am going to single language for this.
Thank you all to come on time. I was just before to coming to session, I was telling when the rhyme was going on my mind. Rain, rain, go away. Come again another day. Amul has to present his presentation to JP Nagar today. So about C. Amul, he's a practicing chartered accountant with over 14 years of post-qualification experience in direct taxation, FEMA, and valuation of financial instruments. Amul has also passed US CP examination in 2018 and has working knowledge of US federal tax regulations. Amul is practicing as a registered valuer, securities of financial asset category since 2020. As a valuer, Amul has worked on several assignments involving regulatory valuations under the IT Act, FEMA, Companies Act for issue of shares, preferential allotment of shares, recommendation of pair share, exchange ratio mergers or demerger, minority buyout, capital reduction, transfer of shares under FEMA from resident to non-resident and non-resident to resident, valuation of debentures, etc. As per him, valuation of shares and securities is a very tricky subject in India. I am sure all of us agree that. Because there are a lot of multiple legislations which include the Companies Act, SEBI, the Income Tax Act, FEMA, and I don't know, many more laws which might be applicable to same transactions simultaneously. The valuer has to look into all the applicable regulations in a holistic way and perform the valuation within the four corners of these regulations. With this, let's welcome C. Amul. Thank you so much.
I like the only lady in the house.
Good evening, everyone. First of all, I would like to thank you for all being still here, even after SARS. Good evening, everyone. So first of all, I would like to thank you, everyone, where you are still here, and even though it's raining so heavily outside. Our today's topic is valuation of shares and securities and the confluence under different legislations. So I have devised the overall presentation in a such a way that I will cover the valuation requirements under different legislations, and then what are the intricacies between the regulations which needs to be considered for the purpose of valuation of shares and securities, so that overall the valuation which the valuer is doing is in compliance with all the regulations. First of all, so this is what the today's agenda is. So I have divided it in 6 sections. The section A is related to preliminary information related to valuation. Then section B covers the valuation under the Income Tax Act and rules made thereunder. Section C covers valuation under FEMA and regulations made thereunder. Section D overall defines what are the valuation requirements under the Companies Act 2013. Section E basically covers the valuation requirements under the SEBI regulations. And then the sixth item, the last item is like how the valuer has to keep in mind the applicable sections which we would have discussed in the earlier sections. So that hypothetical situations I have covered. So moving towards section A, preliminary information related to valuation. So the valuation is defined as per international valuation standards, is the act or process of determining an opinion or conclusion of an value of an asset on a stated basis of value at specified date in compliance with international valuation standards. So as you all know that the valuation is carried out under the international valuation standards. Our institute has the valuation standards which are also followed for valuation of all types of assets, whether it be shares, securities, plant and machinery, or land and building. But overall, on a global basis, international valuation standards are followed for the purpose of valuation. Now, again, this is a very approach which everybody may be aware that price is what you pay, but the value is what you get. And a common example which is given is like a thirsty person is there, he's not getting water, but suppose he finds a shop where he gets a water bottle for 20 rupees. So he would have paid 20 rupees, which is the price. But then the value that he would have got it, the satisfaction that he would have got it, much be of a more, value. So this is the difference between the value and the price. Now moving ahead, I can divide the valuation as a regulatory and non-regulatory valuation. So regulatory valuations are those wherein the specific legislation requires you to perform the valuation of shares and securities as per the specified rules. So in this we will cover the Income Tax Act, FEMA, Companies Act, and SEBI. And non-regulatory valuation is like a business valuation, which may be for not required for a for statutory purpose, but it may be for different actions that usually taken, which includes the acquisition of shares or takeover of a company, transfer of shares, mergers and demergers, etc. Obviously, these non-regulatory valuation, when we say ultimately, converge with the regulatory valuation only. So we have to make sure that whatever non-regulatory valuations are done as per the specific statute. Generally, there are 3 approaches. So whatever method that is being applied in any valuation, okay, that will fall in either of these 3 approaches of valuation of shares and securities. So which are asset approach, income approach, and market approach. So there are various methods, and some famous methods are also there in each of these approaches, like asset approach as NAV method, income approach as DCF method. In market approach, we can use comparable company method. So these are the approaches which are the basis for valuation of any shares and security. Now, generally, when we have to do the valuation, so there is a certain process which is involved and which has to be adopted. So this covers, like, first you have to understand what is the purpose of valuation. Then you have to ask for the preliminary information from the company, so which includes like their past financial statements, what is their future, outlook, or what they see or what their plans are. Like, then we have to consider the underlying, which industry they are working in, what are the characteristics of their products, and what is, if there is any specific or specialized products or not. Then we have to see if we are doing like valuation based upon the projected income basis. Then we have to forecast and validate the company performance, which would have been given by the company. Then we have to, based upon the data, preliminary understanding the information shared by the client, we have to choose the appropriate valuation methodology. So which may fall under the three approaches that we had just saw. And then lastly, we have to perform the valuation and document the valuation and then report it in the form of a report. Next aspect which we can discuss is like the registered valuer under the Companies Act 2013. So as you would be aware that the company's registered valuers and valuation rules 2017 has prescribed the valuation rules in India. So this is the time when the registered valuer concept has come into existence. So section 247 of the Companies Act is prescribes that valuation of any property, stock, shares, debentures, securities, or goodwill, or any other asset which the company is holding has to be done by a registered valuer. So this is a blanket provision wherein under a Companies Act, whatever valuation is there, that has to be done by a registered valuer. Of course, there are certain exceptions to it, which we may come across subsequently. In case of RB appointment, it has to be done by an audit committee. So this is in the case of listed entities, or in the absence by board of directors of the company. And there are three different classes of registered valuers, which include securities or financial assets. So basically these cover valuation of stock, shares, debentures, securities, goodwill, and other financial assets. Then we have plant and machinery and land and building. So these are the type of valuation, registered valuers. So then the next session is now we have covered the basics of valuation till now. Now we will be moving towards valuation under the Income Tax Act and rules made thereunder, which is our section B. If you see the section which covers so these are the main sections under the Income Tax Act, which covers the valuation, which covers or which requires the valuation of shares and securities. So 5627B, which deals with the issue of shares by a company in which public are not substantially interested. And the companies which are not, public is substantially interested is defined under section 218 of the IT Act. So basically this covers the issue of shares by a private limited companies in a common language, I can say. Then section 50 CA, this is with respect to, so anybody who is transferring the shares other than quoted shares, then 50 CA has to be other two. 56 to 10, it talks about, if you are receiving an asset for property, then it has to be received for fair market value. If you are receiving it at a lesser than fair market value, then the income will be taxed in your hands. Section 50. Section 50B talks about the computation of capital gains in case of slum sale. What is the capital gains calculation methodology is defined under section 50B. Then section 9.1 talks about the indirect transfer of shares of an Indian company. So even though you are transferring shares of a foreign company, but that company is deriving value from the Indian majority value, then it will be treated as a transfer of shares of Indian company. So it is usually commonly referred as indirect transfer of shares. And lastly, section 17(2)(6), which talks about valuation of perquisites or sway shares. Similar to as there is a section, there will be rule also. So these are the rules which deals with the valuation of stocks and shares, which we have discussed in the previous slide. So rule 11(2)(a) deals with the determination of fair market value of property under section 56(2)(7). Rule 11(2)(a), UAA, it deals with the fair market value of shares other than quoted shares for section 50(ca). Then Rule 11(2)(a)(e), it talks about the fair market value of capital asset for slum sale, section 50(b). Then UB and UC, 11(2)(a), UB and UC, it talks about the indirect transfer, the calculation of capital gains in case of indirect transfer of shares. Rule 11 is actually, we can say it is a provision which contains the definitions, important definitions which are used in Rule 11(2)(a), UAA, UAE, UB and UC. And Rule 3 talks about the valuation of perquisites. It covers all sorts of perquisites, which needs to be valued. It also has the requirement or contents related to valuation of shares and securities, which are sweat equity shares. Now, before going ahead, it is essential to understand some important definitions of Rule 11(2)(a). So Rule 11(2)(a), first, these are the two important definitions. One is like valuation date. So it means that the date on which the property or consideration, as the case may be, is received by the SEC. Okay, so you have to see when the property is actually received. And balance sheet, it talks about the balance sheet, like in case of Indian entities. It talks of the balance sheet date is different for different sections. Like for 50CA it is different, for 56(2)(10) it is different. So this is what defined under the balance sheet definition. Now this is section 56(2)(7)(b). This section basically talks about if a company, if a private company, a private limited company is issuing shares to any person, like whether resident or non-resident, exceeding the face value and for a consideration which is more than the fair market value, then in that case the difference will be treated as income in the hands of the company. For example, if the fair market value as per section 56(2)(7)(b) is like, for example, say 200 rupees, and if the company is issuing the shares for say 500 rupees, so the 300 rupees is considered as income in the hands of the company. So 56(2)(7)(b) talks about this provision. Now, it is to be remembered that there is a specific exclusion under provision. So this provision talks about the notified classes of persons. This talks about the receipt of consideration by a registered startup. So if a registered startup which is registered with DPIT, it is receiving consideration for issue of shares more than its fair value, then it is not subjected to 56(2)(7)(b). But then this second proviso talks about that you have to adhere to the conditions of a startup. If you violate those conditions, then the exemption that you had got in the past will be revoked. Okay. Now see as per 56 to 7B, the fair market value should be higher of the following. So higher of the following, there are two things. One is that it has to be as per the methodology prescribed, which is basically Rule 11 U8. This rule was amended last year, so which we'll discuss in the subsequent slide. And suppose if you have intangibles, so like you have like a very old company, you have very strong goodwill and all, but then it is not reflected by the balance sheet assets. Then it is likely that your value may be higher, but then it may come, may be taxed under 56 to 7B. So in that case, you have the option that to value your shares of a company basis the intangibles that you have, and then prove to the satisfaction of the AU. So basically, suppose Rule 11 your valuation is 100, and considering your intangible the value is 500, then definitely you can issue the shares at 500, provided you prove to the assessing officer that the worth of my shares is 500. Again, the next point is that 56 to 7B is not applicable to category 1 AIF, category 2 AIF, and fund set up under International Financial Services Centers Act. So IFSC companies and AIFs 1 and 2 are not subjected to 56 to 7B. Now, what is for 56 to 7B, the Rule 11 U8 deals with the valuation of shares. Now there are two rules. One is Rule 11.2A. It talks about the valuation of unquoted shares and consideration received from residents and non-residents. And Rule 11.2B, it talks about the CCPS, compulsory convertible preference shares. Now, under Rule 11.2A, which talks about unquoted equity shares, there are 4 methods. So I have mentioned here, these are the clauses of the rule, and this is the method. So here it is a book value method. In B it is DCF method. DCF has to be done by a merchant banker only. Then under C, you have consideration received by venture capital undertaking for issue of shares from a venture capital fund or venture capital company. Then consideration received from notified company, that is eligible startup. So here these rules are applicable to both resident and non-resident. There is a specific clause D, which is specifically applicable only to non-resident. And the valuation for these 5 methods can be done only by merchant banker. So if you are receiving consideration from a non-resident under 56 to 7B, then you have to, and if you are adopting these methods for valuation of your shares, you have to get it done by a merchant banker. Or if you are getting it done by a DCF method, whether you receive it from a resident or non-resident, you have to do it from a merchant banker. Next is this we are talking about 11.2B. This talks about CCPS. So this again refers to the rules, the clauses which are there under 11.2A only, and you can adopt any of these clauses for valuation of CCPS. Okay, so here are some important aspects for 56 to 7B valuation. So the validity of the merchant banker report is for a period of 90 days. So wherever merchant banker valuation is referred, the validity of that report is 90 days. So you can get the shares issued post 90 days from the date of the report, and that will be considered as the valuation date. Then tolerance, there is a tolerance limit of 10% for value of shares as per valuation report. So like if the valuation report is saying that it is 200 rupees, you can issue the shares at 220, provided for residents who are deriving to as per any method or DCF method. And for non-residents, you are deriving the value as per NAV method or DCF method or any of the 5 prescribed methods. Then again, determination of FFB compare value as per 11A with actual consideration based on intangible. So this I had explained, like, so whatever value that is coming as per 11A, you have to compare it with your actual value based upon the intangibles and all, and whichever is higher, you can go ahead. But if you are going ahead with the higher valuation, then you have to satisfy the ego that why the value is higher than the 11A valuation. Then, so this completes our section 56 to 70. Next is section 50CA of the IT Act. So 50CA basically talks about if you are holding shares of a private limited company and you are transferring it, like selling it, then you have to sell it at a fair market value. So, for example, if the fair market value of shares is 500 rupees and you are selling it at 300 rupees, then still in that case, for computation of capital gains, 500 will be considered as the 200 consideration. This basically talks about unquoted equity shares. For 50CA, we have to refer to either 1CB and 1CC. Okay. 1CB is basically talks about the unquoted equity shares, and shares and securities other than unquoted equity shares is talked in 11A1CC. So basically, this is I have just reproduced the computation mechanism for your information. This is nothing but the rule 11A1CB. So if we calculate in this manner, there is a little chance of getting error in the calculation. So if you see 11A basically talks about the market value of your jewelry, the fair market value of the shares and securities that company is holding, or if you are holding in a property, you have to consider the stamp duty value of that the property itself. So basically, this takes your the value of shares on a realistic basis, even though you are calculating as per the NAV. Now the fair market value of unquoted shares and securities other than equity shares in a company shall be so this is with reference to what we have seen is for quoted shares and securities. This is basically related to unquoted shares and securities other than equity shares. So if you have suppose FCPS or if you have FCDS, if you have, then the fair value is what it would get, the price it would get if it is sold in the open market. That is the fair market value. The third section we'll be talking about is 56 to 10. So this, in this section, what it says is that suppose if you have, if you are receiving or if you are buying shares, okay, of a private limited company or any company like listed shares, the fair market value is suppose 500, and if you are buying it at 300 rupees, then the 200 will be considered as income in your hands. Basically, the rule for valuation of 56 to 10 is the same as 50CA. Okay, so whatever we have seen for 11A, 1CB and C, it is same forward for 56 to 10. Okay, now see again 56 to 50CA is about the unquoted shares. Now 56 to 10 also is there's no difference for 56 to 10 for quoted or unquoted. So even if you are receiving the listed shares at a lesser price, then it will also be covered under 56 to 10. So the mode for valuation of listed shares is there in 11A1CA. Okay, and it is basically depending upon the if you are receiving the shares through a recognized stock exchange, is actually you are buying it, but then buying it at a lesser value somehow. Then in that case, whatever price which is recorded the recognized stock option, that will be the fair market value. And if you are receiving it in an off-market transaction, then what will be the value that has been mentioned? Like the lowest price, if you receive it today, what is the lowest price of that share or today, that will be fair market value. If you, suppose today the shares are not traded, then the previous day you have to see. So this one talks about the valuation of listed shares. So there is a conflict actually. So if you see, if you are issuing shares, okay, if a private limited company is issuing shares, then it has to see, it has to follow Rule 56 to 7B. Okay, and there is a book value method, but in that book value method, it does not talk about the restatement of your assets like real estate or jewelry, etc., to the present day. But in case of 56 to 10, it talks about. So suppose if company is issuing shares for 300, which may be fair value as per the company, or from the company perspective, but from 56 to 10 perspective, the fair value is 600. Then that would impact the shareholder. So there is a conflict between this for issue of shares, but no such conflict is there in transfer of shares because both 50CA and 56 to 10 follows the same rules. Okay, now this is the valuation at a slum sale, that is section 50B of the Income Tax Act. Whenever you do a slum sale, the slum sale is like fair market value of assets as on the date of transfer minus net worth of the undertaking. So there are two aspects. One is the fair market value of assets as on the date of transfer, and there's the net worth. So net worth is nothing but the value of total value of your assets minus value of your liabilities as appearing in the books. CA, practicing chartered accountant, has to certify the net worth before the due date for filing of return of income. And the fair market value of assets, there is a 11 UAE which prescribes two methods, basically fair market value 1 and fair market value 2. And higher of these two have to be considered. Now, in short, if I say that fair market value 1 is based upon the market value of assets and liabilities of the building. So suppose that undertaking may be like 50 years old, okay? It may have land and building, it may have assets whose value has increased so from the time. So the fair market, so this FMV 1 method takes into consideration those aspects. So here, suppose the net worth talks about like suppose the book value of assets and asset minus liabilities is 10 crores, but then this FMV1, if we calculate, it may be like 50 crores. So the gain on undertaking, the transfer of undertaking would be 40 crores. And FMV2 is basically talks about, so if you are receiving another assets in consideration of this slum sale, so you have to consider the market value of those assets. So for example, you are transferring an undertaking and getting some immovable property or other asset. So you have to value those assets. And higher of these FMV1 and FMV2, you have to consider the calculation of capital gains. This is the next provision is related to section 911. Here, if you see 911 says that the income accruing or arising through the transfer of a capital asset situated in India. Now, this term, like through the transfer of capital asset situated in India, is defined in explanation 5. So it clarifies that an asset or capital asset being share or interest in a company or an entity registered in India shall be deemed to and always be deemed to have situated in India if the shares or interest derives directly or indirectly its value substantially from the asset located in India. And what is the substantial value from India is defined in explanation 6. So if the value of the such asset exceeds 10 crores, so for example, if we take, there is a Mauritius company which is exclusively holding the shares of an Indian company. So it will satisfy both of these, and suppose if it satisfy both of these conditions, and if somebody transfers the shares of Mauritius company, so it will be like an indirect transfer provision. In that case, we can say that the Mauritius company is deriving value from the Indian assets. So for 911, there are two rules, 11 UB and UC. So in 11 UB, basically you calculate whether what is the value of your Indian assets. UB talks about two things. What is the value of your Indian assets? And secondly, what is the value of the foreign company? Okay. So because you have to see, based upon the value of Indian company is more than 50% of the value of the total merchant company in our example. And UC talks about how to calculate the capital gains if the indirect transfer provisions are satisfied. Next is like the ESOP shares, or in simple words, what we say is ESOP shares or trading equity shares. How to calculate the what is the valuation requirement? Basically, the rule 381 and 382 of the income tax rules determines the fair market value on India's ESOP shares. If you see, so there are again rule 8. 381 talks about the listed shares and 382 talks about the unlisted shares. Again, like on the date of exercise, if the shares are traded, then what would be the value? It will be the average of the opening price and closing price of the share on that day. That will be the fair market value for calculation research. What is the perquisites in your hands? Then if it is traded in, on more than one stock exchange, then how it is to be calculated. Then next is if it is not traded on the date of exercise of the option, what would be the value, or what would be the price that has to be considered for the ESOP calculation that is mentioned here. And in case of unlisted share, there is an exclusive provision which says that unlisted shares for perquisite calculation, the valuation has to be done by the merchant banker. So merchant banker can adopt any of the method that he or she wish to. So we have till now covered the valuation under the Income Tax Act. Now we will be moving towards valuation under the FEMA and regulations made there. So FEMA, there are only two like ways in which the valuation comes into picture. One is foreign direct investment, that is the foreign company is proposing to invest in Indian entity, and there is a overseas investment, like Indian entity wants to invest in the foreign entity. So for FDI purposes, okay, whether it be equity shares or FCPS or FCDS, which are usually called as a convertible instruments. And if those instruments are being issued to persons resident outside India, then it is governed by the foreign exchange management non-debt instrument rules. Pricing guidelines have been explained in 21 of the non-debt instrument rules. Now the sale pricing guidelines is applicable for issue of shares, transfer from R to NR, and transfer from NR to R. So the pricing guidelines has to be, it is same actually for all the three types of transactions. Now in case of listed company, if a listed company is receiving FDI, then valuation has to be done by as per the SEBI regulations. Issue of capital and disclosure requirement regulations, ICDR regulations, which is normally called. And under ICDR 164 talks about the valuation of frequently traded shares. So if the issuer company shares are frequently traded, then how to value that? That has been defined under 164. And the mechanism is prescribed. What is the meaning of frequently traded shares? It has also been given. So it says that if the trading for the percentage of the number of quantity of shares traded in 240 trading days is at least 10% or of the total number of shares issued of that class. Where shares are not frequently traded and you are receiving FDI, then in that case, the valuation has to be done by the registered valuer, and it has to take into account other aspects like the book value, the comparable trading multiples, and such other parameters. For the valuer, it is important. In case of an unlisted company, if the unlisted company is receiving the foreign direct investment, then in that case, it has to be done as per internationally accepted pricing methodology. And internationally accepted pricing methodology can be anything like net asset value method, DCF method, comparable company method. There's nothing which has been in black and white as far as internationally accepted pricing methodology is concerned. And the report can be issued by a chartered accountant, merchant banker, or a practicing cost accountant. This is something interesting actually. So in case of transfer of shares from non-resident to resident, okay, in that case, the price which is arrived at, okay, it is the maximum price because the funds would be going out of India. And in case of transfer of shares from resident to non-resident, the price arrived at is the minimum price. So this aspect has to be taken into account in case of FDI regulations. So this also covers like swap of shares. So it has to be done by a merchant banker only. So if a foreigners are subscribing to the memorandum of association of an Indian company, then those shares can be subscribed at face value and new valuation report would be required in that case. Similarly, in case of share warrants, if the share warrants are to be issued to foreigners, then obviously those share warrants will be converted into equity shares. So the conversion formula has to be determined upfront. Also, the conversion the price at the time of conversion should not be less than the at the time of issue as compared to the price at the time of issue. Now, again, investment in LLP is allowed, so that investment has to be valued as per the internationally accepted methodology, and it has to be the valuation has to be done by a chartered accountant or a practicing cost accountant. So, no merchant banker in case of investment in LLP. So downstream investment is like an Indian company which has a foreign direct investment of more than 51%. Again, making investment in another Indian company, so it is called as a downstream investment. And thumb rule is like what can be done directly can be done indirectly. So whatever rules and regulations which are applicable for direct investment are applicable to downstream investment also. This is the second like overseas investment, which is like Indian entities making investment outside India, and it is governed by foreign exchange management, overseas investment rules or regulations. Here the valuation, there's no much about pricing guidelines. They have only stated that the AD banker must ensure that the price at which the shares are subscribed is well documented, and valuation certificate should be obtained to that effect. Here, because it would be the valuation of shares of a foreign entity, it is advisable to get it done from the local experts in order to avoid any hassle at the time of making compliances.
Basics of share, the factor of share, higher non-resident in India. Why do we not only sufficient for income tax and payment?
Okay, so this is the question. I'll be coming afterwards, but I'll answer your question. So a single report containing both the legislations, it would suffice. Like suppose if you are valuing as per book value method, okay, and which is in compliance under the Income Tax Act. So yeah, so you can cover first FEMA aspect, which will be value the same value as per the Rule 11 EU, and that would be sufficient. So that can be so Rule 11 value can be considered or terminated, or we can term it as internationally accepted pricing methodology. So combined report can be issued. Yeah, we had issued it and it is accepted at the AD level. This is useful to the client because then they do not have to get two reports. So, and both the reports can be issued by a chartered accountant, so it can be done.
So registered manager cannot be reported, tax.
No, it is not accepted because in under income tax, you have only chartered accountant or a merchant.
The five, the five methods which are prescribed allocated,
yeah.
that was only merchant manager.
Yeah, that only merchant banker. No, that cannot be. So under income tax act, if you are following DCF method or the five methods for non-residents, only merchant banker can do.
That is on the case of the left.
Yes, chartered accountant can do other like book value method or other methods which are prescribed. Chartered accountant can do. But this,
More or less the same.
no, I'll just show you. See, these are the five methods you're talking about. This is only by a merchant banker and this is for non-residents only. And these are other methods. So this is acceptable for residents and non-residents both. So book value of assets and liabilities. So effectively you are right that only book value method is balance for the chartered accountants. Then we'll be talking about the valuation requirements under the Companies Act. I have covered only the main, which is usually considered or usually transacted, and not there are other requirements also, but they are rare, so I have not considered it over here. The first is the preferential allotment. So under the Companies Act, if you are doing preferential allotment of shares in securities, then the valuation has to be done by a registered valuer. It is notable that rights issue is not covered under this section. I think it is covered under 621B. So for rights issue, registered value report is not required. It may be because the rights issue is usually given to the existing shareholders only, and that's why the legislators may not have thought it. It needs valuation from the registered value. Then non-cash transactions involving directors. So if there are certain transactions with the directors wherein assets is being exchanged or bought or sold. So 192 covers both, where the company is proposing to acquire the asset and where the company is proposing to transfer the asset. Both these are covered here. And in that case, the valuation that asset has to be done by a registered valuer. So, for example, if it is a land and building, then the valuer should be the land and building valuer. Or if it is a plant and machinery or shares and securities, it has to be of the respective value. Again, compromise and arrangement, wherever there is a compromise and arrangement is involved with each which is relevant to the NCLT, then in that case, the valuation has to be done by a registered valuer. In case of this is handled at the NCLT level, and as such, the registered value report is important. Again, minority buyout. So more than 90% of shareholders are intending to buy, remaining 10% shares, then they can do it as per the provisions of the Companies Act. And for that purpose, the valuation has to be done by a registered valuer. But in these cases, the valuer has to be very cautious because sometimes in these cases, the minority shareholders have no say as far as their rights are concerned. So you have, as a valuer, the person has to be very, careful, because sometimes if you do a valuation at a lower level for any reason, or if it is not justifiable, then it can backfire the value. Again, if the company goes into liquidation, then the the liquidator has to submit a valuation report to the NCLT, and the preliminary official liquidator can appoint two valuers, and both the valuers can submit their report to the liquidator, which is insolvency professional in these days. Again, business combinations or value measurement. Here you have to, like suppose if there is a company which is subjected to Ind AS requirement. In that case, what happens? And if that company has acquired another undertaking or a business, in that case, what happens is on the date of acquisition, for recording those assets and liabilities of that company in your books, you have to do the fair value measurement of the assets and liabilities, and for that, valuation report of a registered valuer is required. Again, these are the two regulations under Insolvency and Bankruptcy Board, wherein the valuation by a registered valuer is mandatory, and it has to be submitted with the NCLT. Now, SEBI, basically, SEBI, there are various cases wherein the valuation will be required, like frequently traded, which we have seen, which is most of the time used, non-frequently traded and others also. But those are very rarely used. But frequently traded shares is what is majorly used, and we had covered it under the FEMA. So if under FDI regulations, if the company is issuing, if a listed entity is issuing shares, then it has to follow those SEBI regulations. Now this is the this is what I was actually talking about, the confluence of valuation requirements under different legislations. So till the time whatever we have covered under the Income Tax, FEMA, Companies Act, that I have tried to create a situation or wherein we can see the what would be the impact or what would be the valuation requirement under the respective legislations. Like suppose I'll start with this. Like if somebody is doing preferential issue of shares by a company in which public are not substantially engaged. So basically preferential issue by a private limited company in India to persons resident in India. Then in that case, it is a straight case for valuation by a registered valuer. FEMA is not applicable because it is issuing for a person resident in India. And under IT Act, for issuer, if it is a DCF valuation, then merchant banker and any other method, chartered accountant has to do. And for recipient, it is 56-10 method. So recipient, it will always be 56-10, whether it will be a resident or non-resident, because the asset is situated in India. Second, right. So issuer, for example, the company which is issuing, okay, they have to follow 56-7B. So the fair market value, like you cannot issue for a consideration which is more than the fair market value. So you have to do that. But the recipient 56-10 will always be applicable because they are receiving. Ideally, like suppose if you are buying shares of a private limited company. Yes. Yes. So no, it is advisable. Suppose in your assessment, scrutiny assessment, if the assessing officer asks about whether the shares have been bought at a fair market value or not, and in that case, that report would be helpful to you. No, because as I said, the calculations are different actually. But what happens is, like if both are supposed following book value method, 56-10, book value is normal book value. You need not to consider the market value of the land and building or jewelry or other assets. But for 56 to 10, you have to consider those. So there is this conflict which I had explained earlier. There is this conflict.
And so I say that is actual book value.
That is the market value of the asset.
And the sure that for the company will take a report.
Uh,
That is the market value.
That so the rule does not require you to value the asset as per market value. So simple book value method. So it does not require you. So if you see 11 it does not require you to consider the market value of stocks and shares that your company is owning, the land and building which you are owning. It does not require. That value may be like 200 rupees, but your value may be 500 rupees. So you may buy 500. Also, you may not have any problem in that case, but the issuer may have a problem because their fair market value is coming 200, but they are issuing at 500. So then they have to justify why it is at a higher rate. So that option is always there under 56 to 70, which talks about two ways. One is you can go with the rule, or the other you can justify to the why my price is on higher. The next aspect is like everything is same, only you are issuing to a non-resident person resident outside India. Here, PEMA will come into the picture, and the chartered accountant has to do the valuation as per the internationally accepted pricing methodology. One more change here, because it will be issued for non-resident, so merchant banker can adopt the 5 method that has been prescribed here in this. Then the rights issue to resident by a private limited company. As I said, for rights issue, companies act does not require any valuation, but as a part of good governance practice, it is advisable to take the valuation report and keep it on record. Again, because it is issued to a resident, so PEMA is not applicable. And for income tax, for issuer and recipient, 11 valuation can be obtained. Next aspect, combination is rights issue by a private limited company to person resident outside India. Here again, because it is the rights issue, Companies Act does not require any valuation. PEMA, yes, because the issue of shares is to a person resident outside India. And under IT Act, there is one more aspect that if you are doing valuation as per one of the 5 methods, then a merchant banker can issue the valuation report. Next is preferential issue of shares by a company with public or substantially interested. So this is basically for a listed company, for example. So under that issuer, as it is a preferential issue, yes, valuation by RBI under the Companies Act is required. PEMA, it is not because it is issued to a person resident in India. Under IT Act, for issuer, no valuation report is required because it is a company with public or substantial interest. 5627B talks about only if your company is a company in which public are not substantial interested, like a private limited company. If a listed company is issuing, no 5627B. For recipient, so recipient have no excuse but to obtain the valuation report, keep it on record. Then preferential issue of shares by a company in which public are substantially interested to a person resident outside India. So here, because it is a preferential issue, the report by a registered valuer is mandatory because it is being issued to a person resident outside India, so PEMA valuation is there. But because it is a company which is a company in which public are substantially interested, issuer company need not require any valuation report. Again, this is a combination we talked about right issue of shares by a company in which public are substantially interested to a person resident in India. So because it is a right issue, no valuation under the Companies Act is required. FEMA not required because it is issued to a person resident in India. Again, because it is a company with public are substantially interested, so issuer company need not require obtain any valuation report. Only the recipient of shares has to obtain the valuation report under 56(2)(10). The next set of combination is right issue of shares by company in which public are substantially interested to a person resident outside India. So here again same, like because it's a right issue, companies have no valuation is required. Because it is issued to a person resident outside India, yes, FEMA comes into picture, valuation is required. Because it is a company in which public are substantially interested, so it is not applicable. The issuer need not to obtain any valuation report under the Income Tax Act, but for recipient 56(2)(10) is required. Now I have covered here transfer of shares. So if you are transferring unquoted shares of an Indian company or foreign company by a resident to non-resident. So because transfer is between two individuals or two shareholders, present shareholders, so company does not come into picture. So they have to only record the transfer whenever is requested by the buying shareholder. So in case of transfers, no valuation is required for the companies under the Companies Act. But for FEMA, yes, because it is a transfer of an Indian company shares or a foreign company shares from resident to non-resident, FEMA valuation is required. And both transferor and transferee. Transferor 50 CA is required because it is unquoted shares, and the transferee again 56(2)(10) because they are buying property. Property includes shares and securities. So yes, it is required. Again, this is transfer of unquoted shares of an Indian company by non-resident to resident. Okay. So this is a non-resident shares of an Indian company by non-resident to resident. So NR to R transfer, then valuation is required under the FEMA, and under IT Act, yes, transferor and transferee does require to get the valuation of shares. Transfer of unquoted shares of a foreign company by a non-resident to resident. Again, here foreign company shares by non-resident to resident means resident is investing in shares of a foreign company. So it is like overseas investment rules. So valuation under FEMA is required. Transferor not applicable. Why? Because he is transferring, he is a non-resident, he is transferring the shares of a foreign company. So Income Tax Act won't come into picture. They don't have any jurisdiction. But for transfer, yes, you are receiving a property. So even an Indian person is buying foreign company shares, 56(2)(10) will apply because 56(2)(10) does not distinguish between whether you are buying shares of an Indian company or a foreign company. Transfer of quoted shares. Now we are starting the quoted shares of an Indian company by resident to non-resident. So this is a R to NR. Valuation as per SEBI is because it is a listed share, so SEBI valuation is mandatory in this case. For transferor, not applicable. Okay, but transferee, section 56(2)(10) valuation is required. This we will talk about transfer of quoted shares of Indian company by non-resident to resident. So this is quoted listed shares of an Indian company from NR to R. So this is a like foreigner is selling the FDI investment. So yes, valuation as per SEBI regulation is mandatory. And for transferor, it is not applicable. And transferee section 56(2)(10) is applicable under the IT Act. Transfer of quoted shares of a foreign company by resident to non-resident. So again, here we are talking about foreign company shares by resident to non-resident. So the person who has made investment under overseas investment rule is transferring those shares. valuation as per, sorry, your valuation as per SEBI may not be required. There's a spelling mistake also. For that, but then here these shares of a foreign company. So SEBI regulations may not come, but then you have to consider the foreign company shares as normal shares. So for transfer, yes, PPCA will come into picture. You are transferring, so the transferer is an Indian party and they are transferring shares of foreign company, which is equivalent to privately held company. Even though it is a quoted shares outside, so PPCA valuation has to be there. And under Rule 11, you have the definition of balance in under the balance sheet. You have the scope covered for balance sheet of foreign company also. So the rule also covers transfer of foreign shares under PPCA. Transfer of quoted shares of a foreign company by a non-resident to resident. So non-resident is transferring the shares to a resident. It's an investment from India perspective. So that has to be done as per the overseas investment valuation regulations. Transferer, because he has he's a non-resident, he's transferring shares of a foreign company. Income tax is not applicable to him, but then for recipient, yes, section 56 to 10 is applicable. I have covered it at a faster pace, but then in case you have any questions, I would love to answer them. Yes. Sir, what has happened? Yes. What has What has happened, sir? Previously it was there. Okay, I think 5 years back, it was allowed to be done by a chartered accountant, but then they have found certain reports issued by chartered accountants under DCF method with valuation which is unrealistic, is what I understand. And because of that, the rule has changed to cover DCF valuation only by merchant bankers. So it was previously but then that was actually the thing. You are right. We should be allowed to do the DCF value. Yes, I agree with this. I would like to thank you. You all have, been here till the last moment, and I would also like to thank you, JB Nagar CP Study Circle, WRC, for giving me this opportunity. In case you want to connect with me, these are my contact details.
This is the first time we will thank two people. Not just himself also doing a very detailed presentation. I was going through the PPT, which is very detailed. So I request whoever is interested to go to the PPT. And the other person is each one of you is still attentive and attended in the last, because when members are less, we don't feel interested. One thing I've seen, most of people not looking at your mobile, because looking and paying attention to the speaker. Thank you so much for being there in the last. So thank you once again. Thank you all. Yeah.